I think that it's a nice flow to talk about how to sell an investment property without getting hit for capital gains. A few strategies there. You could talk about when you own an investment property, how you should hold title.
It used to be a real disaster, so to speak, for a long time because Fannie Mae and Freddie Mac weren't fans of this concept. So the problem was, it's a very different world today than it was just 5 years ago. Welcome back to the Mordo Mortgage Podcast, or the Mortgage Lounge. I don't know. I think Vivian changed the name for us.
Lounge,
Did you see that?
No, but I like that.
Oh, yeah. We're going to start calling it the Mortgage Lounge.
Sweet. Can we get actual sofa and some recliners?
I think we do need to get better chairs. I was thinking about that. Is there one thing we need? And my wife's been complaining. My height was lower than yours, and now I'm higher than yours. Anyway, not to get distracted, we were going to jump into a few things today. But you were saying something interesting about your brother?
Yeah. So shopping.
In the context of first-time homebuyer stuff, just so this is relevant.
And just that when you're approved, I'll say below 500 around here.
Good luck.
It's really tough.
Yeah, you won't be buying around here.
Yeah, I mean, because even if you...
We're in Orange County, Southern California.
In Orange County, yeah. In LA County, mostly too. There's only a handful of condos that are in that price range. And then if you have to go FHA as a first-time buyer, you have that layer to deal with as well.
Yeah, because not all condos are FHA approved.
But in areas that are not Orange County, there's actually a lot of townhomes that are in that price range. So it just makes it so much easier to get into because now you don't have to worry about all the condo stuff.
When you say townhomes, you mean PUDs.
PUDs, yes.
Planned unit development.
Yes.
Oh, maybe that's a topic. The difference between a condo and a PUD.
A single-family residence within a planned unit development.
Yes.
Yeah, so, and it's easier from a lending perspective because you don't have to worry about FHA approval. It's already, you can do FHA, you can do VA without approval. You don't have to go through full condo review. You don't get slaughtered by what's happening with master insurance in a lot of these high-risk areas. There's still a review, but it's much easier, right? And then for a conventional loan, you have that hit to rate if you're not putting 25% down on a conventional loan.
Interest rates are worse. To simplify, interest rates are worse on a condo for a conventional loan. We're going to do a little mortgage hack for you because how do we even know when we look at a property if it's a condo or a PUD? Now, I'll give you a mortgage hack that's true in Orange County, but only in Orange County. Anywhere else, you're on your own. You would ask your realtor. They'll look it up on the title. All right. So in Orange County, how do you tell if a property is a condo or a PUD, as in planned unit development? You look at the APN number. APN number just is the property identifier as far as the county assessor's office goes, right? Did I say that right? Yeah. So if the APN number starts with the digit 9, that's an automatic giveaway. That is a condo. So that's all you need to know. You're looking at a MLS sheet or something on Zillow, and you see the APN number, and it says 9, and then the rest of the number sequence. That's a condo. If it does not start with 9, it's PUD.
Typically, yeah.
Yeah. I mean, you can rely upon that probably 9 out of 10 times being accurate, right?
Yeah.
But a lot of realtors don't know that. Credit to my old mentor. Thank you, Steve. He taught me that. And every time I bring that up to a realtor, they're like, "Oh, really?"
Yeah.
And no one really knows that. So it's kind of a cool little mortgage hack. Yes, again, reiterating, Orange County only.
Yeah. Otherwise, like you said, you got to check title.
Yeah.
Which either the lender or the realtor can usually do for you.
Yeah. But this is opening up another conversation with like FHA. It used to be way more detrimental when a property wasn't FHA approved. Used to be, okay? It's less detrimental now, and going back to the condo conversation. Not all condos are FHA approved. HUD, Housing and Urban Development, literally has to approve the entire project in order to be eligible for FHA financing, and that's very difficult. What's changed? Well, we can now do site condo approvals. Okay, that didn't always used to be the case. It's been around for a couple years now, something like that.
I think since I've been in the industry.
Yeah,
so.
yeah. So it's been a thing now. Like I'm an old time. I guess I'm aging myself. Yeah. We didn't used to have site condo approval. What's a site condo approval? Well, instead of requiring the entire HOA deal with HUD and get the entire project FHA approved, you want to make an offer on a condo. and it's not FHA approved, well, your lender can work with underwriting to get the individual unit. And I don't know if that automatically, one thing I don't understand about site condos, does that mean the whole project's FHA approved
I don't
at that
think
point?
so, no.
Yeah, so it's just for the individual unit where the underwriting team, the loan officer work with HUD to get the individual unit approved for FHA financing. So that actually opens it up to more opportunity than what used to be available.
Still a challenge because typical turn time, if the HOA cooperates to do that, is 14 days. And then you can't do anything on the loan until it's done because
FHA case number.
You need a case number.
Yeah.
So before you have a case number, which is only happens when you have the spot approval,
Yeah.
you can't disclose, you can't order the appraisal,
Right.
which means you can't put it through underwriting formally.
Easier said than done in a market with low inventory.
Yeah, so if you can get a 45-day escrow, then absolutely a spot approval. And
Yeah.
the seller has to understand that, there's this process just for this thing to work at all. I've done them. And I think most of the time we ask for 45 days, and we usually do them in 35 to 40. So it's not impossible.
They can be done
but
at
it
30,
can be done.
but again, you're at the mercy of a lot of things you don't control, right?
Yeah.
The cooperation level of the HOA.
Yeah. And like we go on the HUD website and see what notes there are for the condo, and sometimes it's really obvious, like, yeah,
It's not going to happen.
This isn't going to happen.
Well,
yeah.
the other issue right now is the obvious problem right now, which is homeowners insurance. And not just for single family homes, but in the context of condos, it's almost even more problematic right now. We're talking on the day of a massive windstorm, and in LA right now, specifically like Pacific Palisades, there's unbelievable out of control fire with zero containment, and people have died and homes are being destroyed. So it's really tragic. But that's one of many examples of why California specifically, and homeowners insurance specifically for condo projects, is a disaster right now. It just is. My wife, who owns an escrow company, just realized a week before closing on a condo purchase that the HOA let the master policy lapse since October. That condo project has had zero coverage of any kind since October, and yeah, pretty disastrous.
Yeah. So with condos, depending on the area, there's still just the entry level home.
Yeah,
So
sure.
I don't think that they're bad, but you do have to do extra due diligence right now to make sure the HOA has it together
Yeah.
and you're buying into a good community.
The good news is, if you're a buyer who needs financing, guess what? The lender's going to make sure that they're willing to lend in that condo. So if they do
Yeah.
approve it, you can rest assured, okay, they've reviewed insurance, they've reviewed the CCNRs and bylaws and minutes and
Reserves and
reserves
a lot of
and
stuff.
financial
Yeah.
fortitude and whether litigation's pending or not, special assessments. This might be going all over your head, but the point is, if you're buying with financing in a condo community, the lender's going to make sure it's worthy of being lent in.
Yeah. So I'm talking to my buddy Tony yesterday, and I was like, "You getting killed on condos?" And he's like, "Nah, bro. What are you talking about?" So
Was that a joke?
no,
Okay.
because he lives in Temecula and primarily does Riverside County and San Diego County. He's like, not as big of an issue because the fire insurance isn't as big of an issue in some of those areas. So with anything,
It depends
in real
on the
estate,
area, yeah.
totally dependent on the local area.
Yeah.
And I think if you put a bow on this whole conversation, it's if you're in an area and a price point where you're right between condo and PUD, try to find a PUD. It'll make your life so much better. And then as your life as a buyer is reflected on what your future buyer of your house is going to be, right? So your resale value should be better. It should be easier to sell in the future just because there's less things that a lender has to go through
Yeah.
if you're buying a PUD.
Yeah. Either way, condo or PUD, it's a great stepping stone property for you first-time home buyers. So don't let that scare you. I mean, you did that.
Yeah, it was great.
I didn't do that because I bought in 2010 in my first home, and it was a starter single-family home, 1,300 square foot, original condition in 2010, so it was $500,000. A little different back then. It's a great stepping stone property, and remember, HOAs, it's like a dirty word almost, right? However, you know, with an HOA, you a lot of times get a community pool and barbecue. Your amenities include, the beautiful landscaping, and they cover the exterior of the home, the roof, things like that, right?
It's a nice baby step into home ownership because you don't have to worry about any of that.
Right.
You don't have to mow your lawn or hire people to mow your lawn. So
you do get something in return.
yeah, I've had 0 repairs in the last 12 months on the condo.
Yeah,
$0. So Yeah, we're paying an HOA every month, but it does also
Yeah.
take care of a lot of stuff for you.
Yeah. So don't worry. You should still buy if you can.
Yeah.
We're going to have a very different conversation to close this out on the other side of this conversation, having nothing to do with first-time homebuyers and condos.
Yeah, almost the opposite of that. Yeah.
It's just from an investor standpoint, where do you want to start? We were talking about 1031 exchange, LLCs, and DSCR. Mortgage gobbledygook.
I think that it's a nice flow to talk about how to sell an investment property without getting hit for capital gains. A few strategies there. You could talk about when you own an investment property, how you should hold title, and then what kind of loans will allow for that.
Yeah, yeah. Oh, where to start? Well, let's talk about 1031 exchange to keep things a little more simple first. We can chat about the LLC thing in a minute, but I just happen to have closed the 1031 exchange, and that same buyer is in escrow for another 1031 exchange. So, what is a 1031 exchange? You want to?
Yeah. 1031 exchange is when you're selling an investment property and buying another investment property.
Income producing, yeah.
Yes. There's rules around this, but the short of it is that you can defer, not eliminate, but defer any capital gains you had on the property you're selling.
Yeah.
And the common strategy is called the triple D. You defer, sell it again, defer, and die.
Yeah.
Or my favorite is you swap until you drop.
Yeah. And you leave it to your kids in a trust or whatever.
At which point the capital gains are eliminated. So essentially, if you are an investor, you own an investment property, and say you have $500,000 in gains, you don't get any tax exemption on that.
Right.
So one of the strategies is to do a 1031 exchange and change properties.
Yeah. So it's just a tax code and loophole that allows you to, when you're selling, a rental property and there was a lot of equity in home appreciation, like you just said, there's no taxable event if you actually roll it back into another property. And, for one reason or another, people are like, okay, I need to get out of this property and I don't want to pay the tax bill. So you just find a property you like better.
Typically, you're going up in size.
Yeah.
In some type of asset class.
Well, a lot of times you're selling an old school single family home and you're buying multifamily.
Yeah.
Right?
Yeah.
And that's what this guy was doing. He had $1 million in net proceeds from the sale of the original rental property. He bought 2 multifamily units in Long Beach. One was a 2-unit, and now he's in escrow for a 4-unit. And he took $500,000 and put it down on one purchase, and he's taking another $500,000 and putting it down on the other purchase.
Yeah, there's rules around it, but it's a great strategy.
By the way, Long Beach, 4 units for $990,000.
Yeah.
Okay, 4 units. I just spoke with the appraiser. Average rent on each unit, $2,000.
Yeah, that's great.
$8,000. Hello, and you can depreciate that property as well. Now, I'm sure there's some capital improvement requirements for that home, given the price point. But I don't know, pretty cool investment.
We did the duplex earlier in the year, and I forget the exact price, but it was like $500 or $600 for a duplex in Long Beach.
Yeah, Long Beach multifamily. Okay, there's a little hint for you.
Yeah. So strategy number 2, which kind of usually an accommodator for a 1031 exchange company is still involved, but you move the money into a DST. I've heard it called deferred sales trust or a Delaware Statutory Trust.
Yeah, this is where I'm going to learn too.
So it's a form of investment that's still investing into real estate, but it's more like a REIT or a stock. It's not exactly that, but it's more like that. So real common when people don't want to be landlords anymore. But they also...
Why wouldn't you want to be a landlord?
Yeah, right. You also don't want to get hit with capital gains, so you sell your property and 1031 it into one of these trusts.
It's pretty cool. I actually like the idea, especially if you're entering retirement. You know what I mean?
Yeah.
Like if you're a 60-something, 70-something-year-old, do you really want to be dealing with property management? Now, sure, you can hire a company, but I think there's a lot to be said for what you're referring to. Say the name again.
DST, Delaware Statutory Trust.
All right, Delaware Statutory Trust. And do you still benefit? Do you happen to know if you still benefit from home price appreciation and stuff like that, or?
So you own a collection of real estate, but I think the thing that people want to know is it does tend to grow in value.
Yeah.
And then you also, most of them will give you monthly income.
Interesting, almost like an annuity in that way.
Yeah.
Yeah. Okay, look that up. And you know who to call? Don't call me. Call Mike.
And then the third one, which I've never seen, but it is possible, is to do an installment sale. So, which is, again, part of the tax code, which is another way of saying doing seller financing. So if you are selling $1 million house and you seller finance $1 million, then you have there's no gain. Yeah. So get with an attorney to talk about how you can draw that up. But
very cool.
If you did a 30-year fixed or something for them, then you would collect the interest that you're getting from that because it's seller financing as income. And then you'll slowly pay the capital gains
over time,
based on how much of their loan they're putting towards principal.
Right. But what if it's interest only?
Yeah.
Which a lot of investors like the cash flow of interest only. So, man, you're smart.
I would, if there's a trust attorney listening or somebody that does this, I would love to hear on some of that. Because anyone I've ever asked, it's really the Wild West. It's like, oh, you want to do 5-year interest only with a balloon payment after 5 years? Sure.
Which I like the setup of an exit strategy as opposed to a 30-year fix, like setting up with a balloon after 5 or 7 or even 10 years,
I think that would be more common is they're still going to probably ask for 10 or 20% down, depending on the scenario, and then, do like a 5-year balloon interest only.
Cool.
Yeah, and you can kick the can down the road on paying the tax.
All right, last piece is LLC and for rental property.
Yeah.
You want to talk about that?
Yeah, so for your primary house...
Not going to happen,
Yeah, you typically want to put it into a trust.
Right.
For a rental property, you want to put it into an LLC. And the reason is that if you put it into your trust, anything in your personal trust is now liable if you have an issue at your rental property. Right. So you put it into an LLC.
Reduce your liability.
And
limited liability corporation.
I've heard from trust attorneys that you should even consider having an LLC per investment property.
Yes.
Because if you have 2 properties, they're both in the same LLC, then they can both be liable for something that happened on just one of them.
Well, and this used to be a real disaster, so to speak, for a long time because Fannie Mae and Freddie Mac weren't fans of this concept. So the problem was, it's a very different world today than it was just 5 years ago. 5 years ago, you're like, okay, well, I need to do a cash out refinance on this rental property, and it's in an LLC. Well, not happening, right? You had to take it out of the LLC back into your individual name, and then there was a period of time, right, where you had to have the property in your name before you could have a chance of financing it again. Whereas these days, I don't think that applies anymore, right? What's the carve out?
No, I haven't necessarily refinanced an LLC, but what we learned is
that... And non-QM you can refinance in the name of an LLC these days, but that's more Alt-A stuff.
Yeah, so, but for Fannie Mae conventional loans, we learned that if you have a property that you want to move into the LLC, as long as you're a majority owner of both the property and the LLC, then Fannie Mae allows for it.
Yeah.
So real common scenario is you buy a house, you live in it for 2 years, you decide you want to buy another place, but now rent out the departing.
Good strategy.
It's perfectly fine because you've lived in it for 12 months and you met that requirement to now move the loan or the home into the name of the LLC, and the lender will not call it due.
Right. Whereas before you were running that risk.
Yeah.
So, these are conversations you want to have with your CPA in terms of true tax benefits and if it's right for you. But something to be thinking about. Like certainly if you own rental property and you own your primary and you don't have a trust and all these properties are just in your individual name, you are running some major league risk from a liability standpoint. So conversations with an estate planning attorney and a CPA and incorporating your loan officer is important, I think.
Yeah, because the more people you have in the LLC and the more stuff you got going on, this is where you really need a team of people to help advise, right? So going back to the 1031 exchanges, the big thing on a 1031 is that you have to have the same title on your selling as on your new. So what if you have it in an LLC, right? Conventional loans don't fund into the name of an LLC.
That's a problem.
Retro, but there's a carve out. So if it is filed under your personal tax return, so if you are the only member of the LLC, or if it's a married couple and they're the only members, it's perfectly fine. Fund into a conventional loan in your name, and then you can later transfer it back into the LLC if you want.
Right.
All right, so you got 5 people in the LLC and you're selling the property. That's where
Yeah, it's
you
probably-
can't do it.
Yeah.
So that's where you could do a DSCR kind of loan where you can fund into the LLC.
Yeah, and these are way more common, especially for you investors out there. You probably already heard of it if you're an investor. I'd say more often than not, especially with Fannie and Freddie and the loan level price adjustments on non-owner stuff, it's almost makes more sense to go DSCR because if it's somewhat well cash flowing and you've got decent down payment and FICO score, the DSCR debt service coverage ratio loans make more sense.
Yeah,
frankly,
I've
and less of a pain in the ass.
past client where
they go off the rents to qualify.
Yeah, based the rents of the property. In some cases, even the short-term rents of the property to qualify, as opposed to personal income. Had a past client where we could have gone conventional, but it would have been really hairy.
Yeah, just all the documentation. Oh man, what a pain in the butt.
Yeah, because they were retired and
so no tax returns are required. Not looking at all the granular detail of what comes. It's like opening a can of worms when you look at someone's complicated tax returns. DSCR, no tax returns. Okay, the appraiser goes out, appraises the fair market value of the property and fair market rent of the property. Now, what's interesting sometimes is a tenant already occupies a multifamily because it's generally speaking a rental property, right? The 1031 exchange I'm handling right now, 4-unit in Long Beach. Well, a whole family occupies all 4 units and have been living there for 15 years. How do you think that cash flows?
Yeah.
No, it doesn't, right? Because they pay like less than 50% of fair market rent. I don't know why owners allow for this stuff. But anyway, we're doing cash for keys. So you negotiate within the contract cash for keys for the existing tenants to move out because my buyer wouldn't really qualify for a DSCR loan because the rents aren't supportive enough. Cash for keys, that's between buyer and seller to determine what the tenant's willing to accept to move out. As long as that's within the next 60 days of close, you're fine. And then we can go off of the appraiser's fair market value of rent.
Yeah.
Interesting stuff.
Yeah. There's always a way.
Yeah.
Well, there's a way.
Yeah, but you need to talk to guys who actually know what they're doing. So, call Mike and I.
Well, this is non-bank, right? If you just go to Wells or Chase,
they won't do that.
They
stuff.
don't do
Wells,
any of this.
Wells, U.S. Bank. They don't even want Govy stuff. They don't want non-QM stuff. They don't want non-owner stuff. They sometimes they'll do second home, but generally speaking, the Wells Fargos and U.S. banks or whoever credit unions of the world, they're just interested in their portfolio products, right? Jumbo money, and then every once in a while their conventional stuff, but they're very limited in what they actually do that's good. Guys like us are the ones who are going to do all the more tricky stuff.
Agreed.
Well said.
Yeah.